Hey everyone, it's Ryan Ponsetti with eXp Realty. Today I am joined with my friend, colleague, and fellow eXp agent, Drew Walk. Drew, thanks for
What's up,
joining us
everybody?
today.
How's everybody doing?
Today we are going to talk about our monthly market update, and we're going to go here and run through our presentation just to update everybody of where we are in the Hampton Roads market locally. We're also going to take a big picture view of where we're going with rates, home inventory, values, all that stuff. So we're going to go ahead and just jump right into it.
Let's do it.
All right. So what you're looking at right now is our snapshot of the local Hampton Roads market, both the peninsula cities and the Southside cities. And the first line is what I want to point out first. And we're going to talk a little bit about this. This is the median sales price for this market. We're sitting at 315 right now. If you look on the left-hand side here, this is your year over year. So this time last year, we're actually up 5% with our median sales price. So home values are up 5% essentially from over the year. And then on the right-hand side of this graph, we're down 1.6% from this previous month. So that's pretty typical. We see usually a drop in sales price. Usually in the winter months, it's slower, less homes available, that sort of thing. But as you can see in this graph too, it starts edging up and usually hits a peak around spring, summer, and we kind of stay there and we come back down towards the end of the year. It's kind of your typical ebb and flow there. And we'll talk a little bit about that more in other slides. Our next line down here is the settled sales, something that I wanted to point out. This is a good indicator of the activity in the market. So settled sales is just what it sounds like. It's how many sales have gone through over a period of time. We're down almost 5% from this time last year. So there's less sales activity this time last year. And then month over month, we are actually down over 11%. So significantly less activity than we had over same time last year and then last month. And then last thing here that we're going to talk about as far as, activity in the market is median days on market. This is the indicator of how long homes are sitting on the market. It's just the median. So kind of think of it as kind of like the average. I know that's not what median means, but each home sells, at its own pace. But this is, taking a look at what, right in the middle, what the middle value is. So we're at 26 days on market, which is a significant increase from this time last year. It's 23% longer than it was this time last year. And it's even a little bit longer, 8% from this time last month or the previous month. So that just means homes are sitting on the market a little bit longer than they were in the previous month. And again, if you look at this curve here, you see the inverse. So days on market get shorter in the spring, summer months, which is pretty typical. But what's interesting is that this time last year, it's even a little bit longer. So coming off of last year's market, we are a little bit slower. That all being said, though, if you look at this next line, average percent of list price received, we are still at 100%, a little bit over 100%, even with it being a little bit slower than it was last month or this time last year. And it's been pretty much the same last month, just 0.4% lower. So it's just slightly below 100% in December. And then this time last year, it's a little bit higher. What that means is even though it's slower, the buyers that are out there are buying, they are paying list price or a little bit higher, maybe just a little bit under in some cases, but sellers are for the most part receiving what they're asking. And then we're going to skip down a couple of lines here and we're going to talk about new listings. So this is positive. Obviously, we all want more inventory coming up. And we're seeing a really sharp increase from December to January. So over 50% more new listings, which is great because, we hope that trend continues and we see more listings. So there's more options for buyers as the year goes on. So we're going to be keeping track of that specifically. And, in the same positive note, it's up 6.5% from this time last year. So even though it's slow, we are seeing more listings hit the market, and we'll hit this in some other slides, but that may have to do with the way rates are going and then our spring market coming up. Last thing I want to talk about on this is our month supply of inventory. So big picture, all said and done, we still have a really low supply of inventory. As most people are probably aware, we're sitting at 2.2 months supply of inventory, which, just to define that, in real estate, we measure inventory by months of supply. So if we didn't put any more new homes on the market in just over 2 months or 60 days, everything would be gone and sold. And for a more balanced market, we want more like 5 or 6 months of inventory. The inventory is up slightly from last month and from this time last year. So that's, again, same thing with the new listings indicator. That's hopeful, but overall, we are still really low. So I'm going to go pass it over to Drew. He's going to talk a little bit about mortgage rates and where we might be headed with that.
All right. So this here is a 24-month chart showing where interest rates have been, where they've gone, and kind of where they're currently trending. If you rewind back to January of 22, we were still in that, pandemic era of interest rates, sub 3%, right around there. And in order to curb inflation, the Fed raised the rates, right? They needed to slow things down. Homes were appreciating at double digits. And you can see that in the graphs. January, 20, from then on through July, they were on a steady increase, going into the end of 22 and into 23, they were at, 7%. They trickled down a little bit in the spring, early of 23, and then they hit an all-time high, just shy of 8%, in October of 2023. And from then on, you can see that we've started to trickle down, which is kind of anticipated what we were hearing on the news and that, which will take us to our next slide. And that will kind of show that, 2023, what those high interest rates, did. They put a lot of people on the sidelines. The prices were still surging. The mortgage payments hit an all-time, record high. But going into 2024 with those rates that started to dip just prior to the new year, you know, we're starting to see the affordability change a little bit. Like experts, they're forecasting that it's still going to be tight because people are locked into really low interest rates, whether they bought in that pandemic era interest rate around 3% or they refinanced at that time. We're still close to double that, and that's going to keep a lot of people sitting tight at their homes. They're going to start putting money into those homes and maybe just remodeling them and just making them the way that they want to be because they're going to kind of hunker down for the long term. But some people are going to outgrow their homes or they're going to need to move, whether it's work or, just a relocation, whatever it may be, but at the end of the day, it's our inventory levels are so low, as Ryan stated in the slide, the first slide there, right around 2 months. That's still going to keep, you know, upward pressure on those home prices. In the meantime, the industry experts here, the Fed has quit, you know, hiking the rates as they anticipated, and hopefully the rates will continue to come down a little bit in 2024, and you'll see in some future slides into hopefully into 2025. But even with those rate cuts, the real estate watchers, they expect home affordability challenges to persist, and that's once again in correlation to that supply and demand. We have a demand of homes that people want to buy, and we have low inventory. So, that's going to keep driving those prices up. So here is a forecast of mortgage rates. So Fannie Mac are forecasting on our future mortgage rates. They're going to potentially continue to dip, through 2024 and hopefully continue on that decline into 2025 and get back to somewhere in between, you know, 4 and 6%.
I'm going to go ahead and jump in here, and we're going to talk about home values and appreciation or depreciation. We'll talk about that, what we might be seeing for 2024. As you might already kind of know or infer, home values are closely linked to inventory levels. And we've already kind of touched on this before. Inventory levels are fairly low. So, actually, really low, historically low, you could say. So, that's influencing the home prices significantly. And it's been pushing the home prices up for over the past few years. They have reached all time highs. And one article I wanted to point out was from Bankrate here and Lawrence Young, the chief economist for the National Association of Realtors. He says it pretty frankly, there are simply just not enough homes for sale, and that our market can easily absorb a doubling of inventory. And that was shown in our local statistics. We're at 2.2. So if we doubled that, we'd be at 4.4, right? And that would just be barely getting us into a more balanced market. So for the amount of demand that's still out there, especially with rates on the decline, like Drew was just talking about, we are probably not going to see a decrease in demand. And we are going to continue to see homes appreciate or at least maintain this level of valuation. So the second part of this article here says home appreciation can only moderate from drastically improved supply. So the question is, where is that supply going to come from? So another 30% rise in home construction can easily be absorbed in the marketplace. And even though there is more new construction and there's more positivity in the new construction industry, they're going to have to turn out a lot of homes to really satiate the demand out there. And we just don't see that happening, anytime soon. So all that being said, that means that prices are unlikely to fall this year or maybe not even next year. We don't know. But, if things keep progressing the way they are going, we're probably going to see at least a maintaining of the status quo here or at least a slight increase. I have this other article with Forbes that highlights another aspect of the housing inventory situation. We call it the lock in effect. And that's where you have homeowners that have either purchased or they've refinanced in the past few years when rates were really, really low, as highlighted by Drew's chart earlier. And during that time period, a lot of people achieved a really low rate. And so that makes their situation very, very comfortable. And so we consider them locked in, and only a major life change, like, a job change or some major life event is going to move those people into another house. Or they could end up just renting it too. So those homeowners have options and they don't have to sell necessarily. So it's keeping a lot of normal ebb and flow of resale homes suppressed. So obviously that's not good for our inventory level, but it is good for home price appreciation. So that's going to help continue to keep things elevated as far as home values go. It says here in the second line that I thought was interesting. I don't expect to see a meaningful increase in the supply of existing homes for sale until mortgage rates are back down in the low 5% range. So probably not in 2024, according to CEO of this company, Patrick, CJ Patrick. And then, as we saw in Drew's chart, they would have to drop pretty rapidly for them to get below 5%. Not saying that it's impossible this year. No one knows 100% for sure, but we won't see a increase in resales where people are more comfortable moving off their house unless they have a real reason to, unless we see rates less than 5%, because then it'll make more economic sense for people to do that. And then it also highlights again for the home builder outlook. It had been on the downside because of inflation and cost of supplies and all that, but it's trending back up. So there is positivity in that space as far as new construction. So hopefully we'll get a little bit of assistance there with housing inventory. And then this graph here is just a snapshot of what we have seen and what we might see in the future as far as home values and appreciation. The red chart on the left, that is this past year over year. And this is a national snapshot and it's right at 5.5%. This is according to corelogic.com. And 5% is what we saw in our local market. As I talked about in our first slide, we had a 5% year over year increase. So we're right in line with the national average. And then the green on the right hand side, that's our forecast for the upcoming part of the year. And they're predicting about a 2.8% increase nationally. So Not as aggressive maybe as the years past, actually far less aggressive than in years past, but still appreciation nonetheless. That's good for homeowners, obviously. But if you are looking to buy and you're waiting for home prices to drop, then you're probably going to be waiting for a long time. So you might not want to do that. In summary, low inventory equals stable or increasing home values. And so that's the big takeaway. We have low inventory. So home values are very unlikely to decrease unless we get some kind of major drop off in demand. But that would only really happen if we had another sharp increase mortgage rates that like we saw last year. But as Drew pointed out, it looks like we're heading in the other direction. So demand will probably continue to go up. All right, Drew, I'm going to pass it back over to you.
Thanks, Ryan. So what we're going to look at now is kind of a spring forecast. Business Insider is stating that this year's rush could push prices up 5% after a weak 2023. It's going to be a stronger than usual spring buying rush since many people were sitting on the sidelines in 2023 due to those high interest rates. And initially, this isn't what some of the economists were expecting. And then you look down to the bottom of that article. This once again, that demand is going to create most likely. I don't have a crystal ball to tell everybody that, but this is based on what some data analysts are seeing. Is that demand, that buying rush could make prices go up 5%. If you buy now, you'll gain 5% equity by the end of the year. Or if you wait till, later in the year, you could be paying 5% more, whichever way you want to look at it. So this here is showing kind of our seasons, right? So if you look at January of 2019, from where this graph starts, is that the number of listings, number of sales goes up in certain times of the year. Once again, winter season, a little bit slower. You get to spring and summer, things surge, comes back down towards the end of the year. And this happens every year. You look at this graph, up in July, down in January, back up springtime, summertime, back down in the fall. And this is just, it's the norm. And these statistics show and back up the information that the data analysts are showing. That's strong spring real estate market. So here is an article from Business Insider stating that the lower rates are going to fall the market, right? So once again, we keep hearing that lock-in effect, the lock-in effect where people were locked into those low interest rates. Now that rates are starting to come down a little bit, people are starting to, kind of jump back in the market once again. Most people, the reason that, there was fewer settled sales last year is because of those high rates, people were hunkered down. So as those rates start to come down, the market's starting to warm up, more buyers are going to come back out, more sellers are going to do the same. So it's been a big incentive for the prospective buyers to get back into the market. A key reason why the housing market is expected to be stronger this year. I wanted to highlight something at the bottom because a lot of folks had the vision in their head that we're going to get back to 3% rates and we're going to, wait on the sideline until that happens. Look, I really don't think that's going to happen personally. And I don't want to really give too much opinion here. This is all based on facts and data that we're pulling from these articles. But right here, it says borrowing costs aren't returning back to their pandemic era lows. Once again, the rates were dropped to help the economy with the pandemic and curb that. And then it created inflation and then it created higher interest rates. So here we are. So right here is a graph showing what happens with the correlation of home sales and mortgage rates. So and this goes back to 2014, right? So we have, several years of data here and we'll start in 2019. We'll start just pre-pandemic there. So when the rates hike up right here, 2019, rates go up, home sales tend to go down. You venture into 2019, towards the end of 2020, those mortgage rates dropped, sales went up. Spring of 2020, when COVID came along, those rates started to drop. They started to drop drastically. sales went skyrocketing. And then, they were kind of up and down a little bit through 2021, and then you get to 22 when inflation was really getting high. That started to hike the rates up. You see that crisscross there, spring of 22, when those rates started to get to an all-time high and start on that incline, rates went way high, settled sales went way low. And that's the correlation, that we want to, provide you with and kind of just show you what could potentially go on here, what's expected, over time with all this data. So here we are, we're going to get kind of into our local market here. Virginia's ranked, the third hottest market to watch. And as you can see, this article was written February 12th, 2024. So, the rates have fallen to about 6.8% from October's high, which was close to 8%. You know, However, with continuing signs that inflation is ebbing and predictions that the Fed will be cutting its rates by the middle of 2024, if mortgage rates, also decline, the market should slowly begin to thaw out. Once again, more buyers, more sellers will come back into the market. Still, since this thaw will not be equal for all markets, buyers and sellers armed with the most research will be in the best position to jump into the market when the timing is right. And that's what we're trying to provide you guys with is education here and data. This is not our personal opinion. Once again, here you go. Hottest markets overall, Denver being number one, Raleigh, North Carolina, number two, Virginia, number three, and then, two more North Carolina localities, following in at number four and number five. These are the hottest markets ranked from one to five. And you look over on the right side of that, and there's just more on that list. That's all. It's the same thing. It just shows you a few more localities, past that one through five ranking. So here we are, still in our local market predictions here for 2024. We're going to have more sellers returning to the market who are in that lock-in effect. We'll just skip right down to point number three. Same thing with buyers. They were trying to avoid those high interest rates of 2023 that got once again to that all-time high of almost 8% in October. And home prices will continue to rise. And that's really due to that supply and demand, that inventory that's our all-time low, that's going to continue to keep the prices ticking up. And once again, they're anticipating that 5% increase. New construction is supposed to increase, hopefully, from what we've seen. And hopefully that'll add some more inventory into our market. And, at the end of the day, this is all information that we've collected and gathered. In a quick summary, it's this low inventory is equating to a stable in increasing home values. At the end of the day, that's what we're looking at. Ryan, what else do you have to say, man?
Yeah, thanks for that, Drew. Appreciate all the information. I'm sure everybody who stayed to the end of the video also appreciated it. Guys, we are going to be doing this every month, bringing you a market update. Me and Drew are going to hop on here on the Hampton Roads Information Network. So subscribe to the channel, follow us on Facebook or Instagram. Our contact information is going to be here at the end of the video. So reach out to us if you have any questions about buying, selling, investing in Hampton Roads. We appreciate you guys, and we will see you out there.